And so obviously gold hit nominal highs in many currencies, including the US dollar. It's over 27%. And in the Eurozone where I am, it's over 33%. And the Swiss franc, 36%. So obviously a very good year for gold. Again, that wasn't just market genius. I wasn't alone in that. I certainly was bullish for both, which is ironic because usually I'm very cynical. And I still am cynical about markets. And we could talk about this year. But, again, with gold, and we'll get into more detail, for gold it's always simple because debt never changes. And there's a debt collapse driven by sovereign debt crisis, not just in the U.S., but globally. And gold doesn't rise because it's in a bull market. It rises because fiat money's in a bear market. And that, just simply isn't going to change. It hasn't changed. It certainly hasn't changed yet.
Over the past few decades, gold has retained its value while fiat currencies have continued to drop. The purchasing power of the US dollar has declined by at least 7.5% compounded per year over the last 5 years. As nations adopt fiat currencies, they face balancing economic growth with inflationary pressures. High inflation can diminish purchasing power and erode savings. Such conditions often lead investors to seek refuge in gold, increasing prices. For example, during the financial crisis of 2008, gold prices surged as investors doubted fiat currency stability. Market expert Matthew Piepenburg mentions that rate cuts indicate economic challenges, such as unresolved inflation and rising debt burdens. In particular, gold benefited from this environment, reaching record highs in multiple currencies, including the US dollar, euro, and Swiss franc. Forecasts suggest that gold could reach around $6,800 per ounce by 2040, reflecting a rate of return of 7.2% annually. This projection underscores gold's potential to deliver returns surpassing typical investment assets. Analyzing the market for 2025, Piepenburg predicts a cautious market outlook due to less decisive Fed signals. While Powell remains dovish, hints of rate hikes or limited cuts add uncertainty. Fed officials indicated they now expect to cut rates by just a half point in 2025, which would likely mean 2 rate cuts at their 8 policy-setting meetings. Experts like Matthew Piepenburg emphasize the $690 billion U.S. deficit, comparing it to wartime spending despite no war. He explains that supporting the debt market weakens fiat currencies, making gold a reliable wealth preserver. One analysis suggests that gold prices increase by approximately $1,000 for each $15 trillion of debt. When the national debt was around $15 trillion in 2009, gold was around $1,000 per ounce. When the debt reached $30 trillion in 2020, gold was around $2,000 per ounce. However, the general trend line for gold prices has been to mirror the rise in the national debt. The above ratio of gold price to debt level for the current debt level suggests that the current gold price should be above $2,500, and it is. Now, we present the clips of Matthew Piepenburg's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Hold my nose last year and be risk on, despite kind of having fundamental problems with this market bubble, but the Fed was clearly signaling a dovish 2025, and my simplistic reduction of how markets work is when a central bank is dovish, markets tend to rise, and when a central bank is hawkish, they tend to retract. And last year at this time, it was fairly obvious from November all the way into December and January when we met here that Powell was throwing in the towel on rate hikes and going into cuts, which is precisely what happened in 2025. It wasn't in 2024. It wasn't until later in the year, but it was already signaling. And the market, again, being Pavlovian, just the carrot dangling of a rate cut got markets galvanic and hopeful, and it was a tailwind, and we saw a pretty decent year in the S&P as expected. But again, rate cuts to me were a sign that despite not hitting target inflation and not beating the inflation, taming it, that rate cuts were a desperate move at the same time. So it was kind of bipolar, but it certainly was a tailwind for the markets. But rate cuts were also a tailwind for gold. And so obviously gold hit nominal highs in many currencies, including the US dollar. It's over 27%. And in the Eurozone where I am, it's over 33%. And the Swiss franc, 36%. So obviously a very good year for gold. Again, that wasn't just market genius. I wasn't alone in that. I certainly was bullish for both, which is ironic because usually I'm very cynical. And I still am cynical about markets. And we could talk about this year. But, again, with gold, and we'll get into more detail, for gold it's always simple because debt never changes. And there's a debt collapse driven by sovereign debt crisis, not just in the U.S., but globally. And gold doesn't rise because it's in a bull market. It rises because fiat money's in a bear market. And that, just simply isn't going to change. It hasn't changed. It certainly hasn't changed yet. And so 2024 was, again, not totally easy to see, but fairly accurate. And to your question now, on 2025, on the markets, I'm less bullish. Again, not just the Pavlovian, see what the Fed does already. Powell. It is fascinating, by the way, that we have to spend so much time talking about a central bank to discuss markets, because technically, ideally, we should have natural supply and demand, free market discovery, fundamentals, balance sheets, price to book, price to earning, a basic Benjamin Graham Buffett analysis of markets. But what we're really talking about first is the central bank. And again, as in this year, Powell is still dovish, but moderately dovish. You know, he's talking about rate cuts, but throwing out the possibility of less rate cuts or even a potential rate hike. Just that kind of moderate language as opposed to strongly dovish language. That is already a signal that the markets are a little curious or concerned.
While reflecting on the market, Matthew Piepenburg outlines Trump's key economic themes, including tariffs, government efficiency, and reducing debt to GDP. While these policies aim to combat inflation and boost domestic manufacturing, Piepenburg warns they may inadvertently be inflationary and politically challenging. Amid the flurry of actions, President Donald Trump's first day in office Monday was a memorandum calling on federal agencies to find ways to solve what Americans call their biggest financial burden: inflation. Suppose Trump implements widespread tariffs on imports and deports millions of immigrants. In that case, economists predict inflation could intensify, reducing the likelihood of significant interest rate cuts by the Federal Reserve this year. Deutsche Bank estimated that Trump's threat this week to impose 25% tariffs on imports from Canada and Mexico on February 1st would drive inflation from 2.9% in December to 3.7% by the end of 2025. Trump also said he's considering another 10% tariff on China on that date. Concurrently, Piepenburg mentions the difficulty of cutting entitlements and military spending and addressing embedded bureaucratic inefficiencies while maintaining economic stability. Let's get back to the interview.
Trump has a few key themes, the tariffs, this Department of Government Efficiency, which we can talk about, which again, I'll just say the short answer is those are inflationary policies. And he said he was going to beat inflation. I think he may not have said that disingenuously. I think he underestimates that. I don't know if that's condescending, but I think he does. And he has this desire to beat inflation. He has this desire to cut spending. He has this desire for tariffs and this government efficiency. And before you can even look at all of those things, which I think are going to be inflationary, at the top of the pyramid of that discussion is the key to him succeeding is to get debt to GDP down. And the problem is with debt, and whether it's him or I've said Santa Claus or Papa Smurf, that's going to be hard for anyone. So I don't blame him in and of itself. It's going to be very hard unless he cuts severely into entitlements and military spending, because entitlements, military spending, and interest on debt are 75% of the budget. There's not a lot of room to play. So if he really wants to take the debt part of the debt to GDP ratio down, he's going to have to make a revolutionary change in entitlements or military. That's very politically difficult to do. The Department of Government Efficiency and the pink slipping of 75% of the fat and bureaucracy of D.C. is wonderfully optics. It's very good. There's a lot of waste in D.C. bureaucracy, just like there's in any bureaucracy. But 25% of GDP comes from government. So if you just pink slip the Department of Education and a lot of waste on the Beltway in D.C., that has great optics politically. It may even be necessary. But you don't want to do that with a strong dollar, because you're going to be letting a lot of people out. There's going to be a decline in GDP just by the nature of government spending. And even with Elon Musk and Vivek doing that, again, these are complex topics. They take more than a few minutes. But the question is, does he even have the mandate for that? He has the mandate to raise tariffs through executive order. D.C. is very embedded, very full of political, I hate to say the word prostitutes. They'll do whatever their lobbyists tell them. They'll do what their embedded structure is. So they will sacrifice whatever values for the country they have for the good of their lobbyists. And the question is, with the majority in the Senate, the House, et cetera, can Trump really get Vivek and Musk to have full reign to do the kind of things and get the support from the legislator? We'll see. But again, to do the cutting of the fat in D.C., I understand that will have an effect on GDP, though. And that necessarily, when you lay off levy people, when you have a strong dollar, you put them into a levered economy, 70% of GDP comes from the consumer. If you've got less consumer strength, that actually makes GDP worse. So he's battling a lot of moving parts. I'm not saying he'll fail, but it is certainly going to be important to do that with a weaker dollar. And that's another topic. But the other big topic, of course, is tariffs. And there's two ways to look at the tariffs. On the positive side, clearly, for example, I live in France. The French have a 25% tariff on American wines. I live in Bordeaux. You can't find American wine in a French restaurant. It's a simple example. So you can say heroically, Trump is saying we've got to make changes. There's imbalances in trade. We got to play hardball, and this is how we're going to do it. That's the positive side. The extremes, 45% tariff to Canada, 100% to BRICS, to trade outside that. These are very dangerous things. They're very inflationary things. And I think despite all the good intentions to reorganize fair trade, which I understand, and again, this could be 30 minutes on this, but I'll try and simplify one small example of how this, history doesn't repeat itself, but it rhymes. We did try tariffs in 1930 under Hoover. It was called the Smoot-Hawley Tariff Act. Blow the dust off the history. Again, it's not exactly the same situation, but it's close. And the long and short of it was when they did those tariffs, it was a disaster. First of all, Hoover didn't get reelected. Both Smoot and Hawley, the senators that it was named after, didn't get their seats back. It led to a massive amount of retaliation and export declines from us, the tariff the wall maker. So there's going to be reaction, tit for tat. And the question is, who can hold their breath the longest on this? How much instability will it create? How much inflation will it create? How much stress will it put on our economy? What the pro-Trump camp would say is, yeah, those are possible risks, but the only way to reshore manufacturing is, frankly, to punish American CIOs and companies offshore in Asia, in South America, getting cheaper labor, putting a huge, pain on their products coming in. So if they really want to have an American buyer, an American camp, an American demand, they better bring their manufacturing back to avoid those tariffs. And I can understand the optics of that. So again, there's a lot of if but going on. Trump will definitely do what he says. Again, whether that's efficient, whether everyone cooperates, whether the West will cooperates, whether GDP cooperates. But the bottom line is, unless he gets the debt to GDP ratio down, he can't succeed, because historically, when debt to GDP crosses the Rubicon of 100%, we're at 125. I mean, this is going back to classic economics, certainly to David Hume. Growth stalls by 1/3. And you need to get growth, you need to get productivity in the GDP. Deregulation that Trump is going to offer, that's helpful. But again, that will not be enough. He's going to have to really cut the debt side. And the spending cuts that the Doge camp will create isn't nearly enough.
The Commonwealth Bank has made a bold prediction, reinstating a $3,000 per ounce price target for the fourth quarter of 2025. This forecast is backed by comprehensive market analysis and economic indicators suggesting continued gold price strength. With rising global debt and central bank challenges, will gold remain a trusted store of value, or will new strategies replace it? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.